Hey traders, welcome back to another backtesting review. So let's have a look at this trader's backtest. So it's a very short one. We only have 15 trades here. But anyway, let's have a look. I can see that the trade frequency is quite low. You see on average every month he only have 2 to 3 trades. You see February 1, 2, March 1, 2, 3, April only 2, May only 2, June 1, July 1, August 1. So we'll see. And one thing that I need to say is I've repeated this multiple times. When you're doing your back test, please don't mix up all of the strategies together. So you see, on one side he's trading pullback and BNR here, key level here, pullback. So the whole point of us doing back testing is to be pattern focused. That means we focused on one pattern. So if you combine it, it's very messy, and end up after you do all your back test, you might have to throw them away because they are meaningless. But anyway, let's have a look. But I do understand why some of you do that. It's because you want to feel like you're trading the live market. You want to have a feeling of, what if I really trade the live market, combining all of the knowledge that you have learned from me, from our education. But the thing is still, when you do backtest, it is very noisy when you combine multiple patterns together. So this one valid, I can say, is a VNR plus TPF here. So it's a valid trade. And also, when you run on your backtest, you have to fix on your trade management as well. So it is very important to say, okay, so on this specific backtesting sheet, I'm using a set and forget approach. You need to have a fixed trade management model in order to have consistency as well. Because the last thing you want to do is on your backtest, some trades you manage this way, some trades you manage that way. At the end, you don't even know how do you manage things. Subjectivity is the biggest ever enemy in trading. So when you have too much subjectivity, you are not being efficient, and essentially, again, there's no way you can be consistent as well. So normally my approach will be all efficient. No, we recently have a lesson on this as well. When price revisit the price swing low, swing high, we move stops to B. So this trade technically should be a BE trade, because this trader is combining all of the knowledge that he had. So you see TPF, BNR, pullback, range, multiple patterns together. You need to have a complete trade management model as well. So this one, yep, okay, makes sense. You're probably trading the minor breakout. So next one, TPF, very good. So this is a good trade. So this is a combination of buying support plus a TPF pattern here. Also, so up here, and also one thing, if let's say you're entering based on pin bar like this trade, you better make sure every time when you see a pin bar, that will be entry trigger. So everything has to be fixed, and that's the main reason why I said I don't care too much about candlestick pattern. Like, oh, one pin bar, one doji, they really don't prove anything. But if let's say I see multiple candles rejecting a level, I don't care about the size. I do care about the size, but if let's say I see multiple wicks rejection and support, or I see price slows down when it approaches a support, or let's say price breaks a resistance and right after the break it slows down, then that will be a valid trigger. Okay, so like this one is just based on pin bar. You better make sure next time when you see a pin bar, that's your trigger. Otherwise, again, subjectivity. So this is a bull flag trade. Good. Okay, this is Seems like a TPF. Can't go to M5 and the 2083. I don't really consider this a TPF, honestly. It's too tight, it's too small, it's more of a consolidation. You can even call it a bull flag in this way, so it's not really a TPF. Remember the context of TPF. When you see price faking out the high, creating a clear left right shoulder. So this is also a bull flag trade. Okay. Yeah, bull flag trade, correct. So if you may notice that since 2024, let's say 2023, 2024, even this year 2025, if you were to just blindly buy into gold, you probably have made a lot of money. But again, I'm not sure when you do your back test if there's any sort of hindsight here, because if I were to know the current gold price action and I were to put on a replay bar, I would definitely say on my back test I'll just keep buying. So I think if you want to have a more realistic back test, you probably might have to go back to the price action before 2020 COVID period, or you just back test another pair, because again, gold has been pretty easy in terms of, you know, if you just keep buying continuation, so it's a bit unrealistic here. And also another thing here, you better define how you better be more precise on how you define a flag, because I can see some of a flag have different pattern. Like what is this? Why do you draw upper bottom line when price doesn't even respect it? You don't force a flag like this, you see? You don't really force a flag. A flag has to be clear, has to be sharp. So some good example would be this one. You see how clear is this? That's not a flag. This is too early to even call this a flag. This one, it's way too early. You only have a few, how many candles? You only have like 3 candles. You don't even have upper bottom band. Why do you call this a flag? Unless you say, okay, I'm entering after I see this fake out and price form a left right shoulder. That makes sense, but this is not valid at all. It's a bit forceful. So again, another key thing here is you better define under what situation, under what price action can you take aggressive reversal entry, because buying support is not a strategy. Everyone knows how to buy support, knows how to sell resistance. Buying support, selling resistance are not strategy. So if you look at the price action here, price was basically just revisiting support. That's it. It's not even doing any sort of pattern. It's not even within any of our strategy. Like this one, you call this a bull flag. Okay, I do get it. But in my live trading, I like to combine flag with other confluences. But anyway, you're just doing back tests. So if you're pattern focused, then I understand. But yeah, I feel like on your back test, there's too much subjectivity here. Like, for example, this one. The question is, how do you define the support? Right? You see, this is on the 1 hour. Like why do you buy into that bounce? Like why do you buy there? Let me see what strategy. BNR. How do you define a BNR? A break and retest to us has to be price testing, price swing high, swing low. Like if it says a BNR here, it's a bit mixed as well. Like you didn't even show why you buy it there. Next one. Oh, okay. So you were buying on that break and retest. But I still have to advise you on one thing. I much rather you enter your position based on limit order instead of waiting for a candlestick pattern. Because again, when you enter a trade based on candlestick pattern, your entry, how to describe it, your execution will be somehow delayed. Because sometimes pin bar can be bigger, pin bar can be smaller. So if let's say you enter on the trade based on bullish pin bar, what if the pin bar is only 5 pips? What if the next time the pin bar is 20 pips? What if the pin bar is 50 pips? You might feel like, hey, it's fine, right? As long as I fixed on this, if I see a pin bar, I buy kind of strategy. My strategy is well defined. But another question here is the way you enter a trade will also ultimately affect the way you place your stop loss. So if let's say you enter based on that pin bar, this one bigger, that one smaller, or whatever, your stop loss size is going to be different. And when your stop loss size is a bit different, your risk reward is going to be affected as well. How do you define your TP? And another question here is, how do you define the TP here? Another big question. And again, this is it's a bit unfair to judge, to judge based on just this short backtesting screenshot. But when you're trading an all-time high asset like gold right now, TP is always more tricky. So to define a clear TP, it is quite tricky. So move on to the next one. This one also, you see, price rejected the support, but from I see here, it didn't tap the support. You see, subjectivity. You see that? We didn't tap. You have a support zone here at at which area? Around 24.41. Price didn't tap it. You see, it didn't tap the support. So why do you define this as a BNR? Right? So again, subjectivity. Yep. Okay. Makes sense. This one is good. A plus TPF, and that's it. So my advice to this trader is, first thing, split out your backtest. Don't combine them all into one sheet, because again, the whole thing of you doing backtesting is to check the statistics of the specific strategy and see if it's actually an edge. If there's actually an edge, if you combine all of them, you end up still have to split them out into different Excel sheet, because how do you know the efficiency? Second thing is, define your criteria, define your rules better. Whether if it's entry model, whether if it's your trade mesh model, exit model, define it better. Don't sometimes enter based on pin bar, sometimes you enter based on inside bar, sometimes you enter based on small rejection, sometimes you enter based on price rejecting support from a pin bar, sometimes you enter when price did not even do a BNR, like this one. It didn't even tap the support, and then you say it's a BNR. So again, too much, it is too diluted. And the third thing is, I even forgot what's the third thing, but anyway, just be more specific, be more, define your rules, your criteria a lot better. Otherwise, this will directly reflect on your personal performance as well, which is again very subjective. So to me, trade management model is one of the most important thing. Entry is the easiest to fix. So let's say today your strategy is I buy bullish engulfing. Every time when you see a bullish engulfing, you just go long. The tricky part is how do you put your stop loss in a mechanical manner, plus how do you manage your position? Because we make money by exiting a trade, by closing a profitable trade, not by entering a trade. So trade management first, then you have your entry and your exit, then you have your risk management. Risk management is also the easiest one, because you can easily have a fixed risk per trade system that will allow you to have consistency. The most tricky part is your trade management, your skill in, skill out model, your exit, then entry. Entry is the easiest one. So that's it. Talk to you later.